Oh, you're back. You want to talk business now? Fine, I'll put on the kettle. Now I'm going to be straight with you here. The Big Beautiful Bill, or just Bill, is really dedicated to solidifying many of the tax changes which came about in 2018 after President Trump's first year in office. Yes, there are provisions like the tax-free tips and overtime exemptions. See our last video for more details on those. But the second Trump administration is really about getting those engines of American commerce roaring again, with quick and easy deductions, which go straight to the bottom line of many 2025 returns. Surely you're going to want to take a look at what's in store for next year's business deductions. So come back to Adventures in Data and Finance today, where we'll be talking about the Big Beautiful Bill's provision for business taxes. As always, be sure to like, subscribe, and turn on those notifications so that you can get fresh updates as soon as we can move them out. Oh,
and don't call me Shirley.
For the titans of industry out there, let's get the elephant in the room out of the way and talk about bonus depreciation. It's true that Bill is making 100% deductions great again. That is, for qualified assets put into service, they are now permanently allowed to be bonus depreciated up to 100% in order to drive up local American business interests. But hold on there, Patricia. You wouldn't be thinking of that the government is giving you something for nothing and your chicks for free, now would you? Before you go writing off everything you can grab from your local Costco, let's take a step back and look at some of the perils that are out there if you don't use depreciation wisely. First, there's depreciation recapture. This is like the evil cousin of bonus depreciation lurking out there for you at the end of the life of the asset when you decide to sell it off that old fridge at the back of the warehouse. If you're not careful, not only are you going to force future you to pay extra taxes, but there'll be ordinary taxes with a higher tax rate that comes with that. Secondly, it costs something to get something. This makes sense when you think about it. But in a tax year like this one, there's always that temptation to try to eliminate any taxes through expense write-offs, but this means that the building you just wrote off can't be expensed for the rest of its life. For longer-term assets, like that new office building across town, there's now a temporary 100% deduction for investments in certain long-term structures associated with local production of goods in the US. For these structures, they have to be constructed after January 2025, but also before the end of 2028. Again, funny that year keeps on coming up. Effectively, this allows for cost recovery immediately instead of taking up to almost 40 years under the previous rules. So that last part talked about tangibles. You know, the stuff you can see and touch and sometimes even smell. What about the stuff you can't put into your hand? Well, R&D amortization has been a hot topic since the first Trump term. So I'll turn it over to my good friend Nemanja, who is an expert in R&D tax credits, to explain it while I go refill Bill's coffee.
You know, the R&D tax credits have been great. We were able to give back a lot of funding to a lot of our clients that they can reinvest. And a lot of people seem to associate R&D with really, scientists, guys in lab coats, beakers, engineers, pharmaceuticals, Pfizer, Johnson & Johnson. And, while that is, of course, R&D, it's what we usually call classic or pure R&D. But the truth is really many businesses qualify without even realizing it. Anytime you're developing a new product, improving a process, or adding new features to something you already have, you may be eligible. So we're really excited that the Big Beautiful Bill passed, which of course removed those amortization requirements, and the credits again became a really powerful and essential part of many of our business strategies.
Much of this year's business tax changes can be described as a defensive football strategy. You may not be gaining much, but you're not losing yardage as well. Most of the goodies we got back in 2018 were going away in 2025 until they were perma-renewed. QBI was a big one for a lot of small businesses, knocking off up to 20% of the qualified business income taxes that a small business owner had to pay. The phase-in limits, for those that applies to, also got topped up, so you're not having to stress over being too successful this year. Finally, the QBI changes throw us another treat this year by adding a minimum deduction of $400 for taxpayers with at least $1,000 of QBI from an active trade or business. which is good enough to help pay for parking at Disney World next year. On the other end of the spectrum, businesses which are growing and going international have a couple of things to look out for this year. GILTI, the global minimum tax on international income, and yes, these guys actually called it GILTI. It's now been renamed to NCTI, or necktie, I guess. In line with Donald Trump's push to own the countries not located here, the new law will actually raise the overall effective tax rate from just over 13% to 16.5% in 2025. So this one's not really going to be a big deal, but I wanted to bring it up since it shows just how dysfunctional Washington can be. Back in 2017, when the first Trump tax changes came in, they eliminated something called downward attribution, which basically dealt with US persons covering for the foreign companies they owned. A funny thing happened on the way to the IRS though, and doesn't it always? And it made these companies controlled foreign corporations, and that made some minority shareholders of these companies, who had no control over them, responsible for a truckload of IRS reporting they had no access to. Anyway, all this happened because the 2017 bill removed one line, yes, one line, from the tax code, and the IRS went to work doing what it does best. So why do I bring all this up? Because, let's be real here, the international tax world can be a scary place sometimes, but not as scary as when your tax return ends up overseas without you knowing it. Many firms are outsourcing tax preparation to stalwart American allies like Pakistan.
Pakistan, we're getting somewhere.
That's right. In fact, we had someone from that country reach out to us recently offering to do client returns from Pakistan. Don't worry though, we were told that because there was an embassy in the US, tax filers could sleep well knowing that, like the Mounties, the US always gets their man if it has to come to that.
Ladies and gentlemen, we got him.
If this isn't giving you the peace of mind that was expected, don't worry, it doesn't sit well with us either. That's why at Palmetto Maple, your tax return stays in the US. Always. We won't even let it go for a day pass in Niagara Falls. The Canadian side, that is. Because we believe that your family and business's sensitive personal information is one of your most precious assets. All of our staff are based right here in the good old US of A, and available when you need us. If you believe local matters when it comes to your taxes, click on the link below today to save 10% on next year's tax return. Your tax papers will thank you for it. The business interest deduction was a bit of a controversy over the last 8 years since it was first introduced in the TCJA of 2017, because it included depreciation, amortization, depletion, and other fancy words that us accountants use to put our kids to sleep at night. Basically, after the bill passed, there were changes made during the first Trump term and also the Biden term as well. And now, the change is made for good in 2025, allowing all those extra expenses back into your interest calculation, and is intended to lower the after-tax cost of both existing and future debt for borrowers. Finally, even though the green energy credits will be going away after June of 2026 next year, the SAL deduction will be going up to $40,000 from the original $10,000 it was at the beginning of the year. This probably won't be winning over any fans for Donald Trump in certain parts of the country, but hey, a tax break's a tax break. And with that, we wrap up our look at the business tax changes for this year. Be sure to subscribe to our channel, where next we'll be looking at why data is about to cost your business a whole lot more in 2026. Thanks for watching again, and see you soon.